Hi, this is Durrett with goldsilverdata.com, and I'm going to do my valuation YouTube videos, how to value gold and silver mining stocks. This came from my website. There's a menu option on goldsilverdata.com called Mining 101. You're probably reading it. Could be watching it from there. Could be watching it from YouTube. But that menu option, Mining 101, is a write-up of how I value mining stocks. It's 10 steps, and I'm going to put that into 3 parts, this YouTube video. It should take about an hour, I'm thinking. So let's go ahead and get going. So the first thing I want to do is do the introduction, do a little overview. I want to give you a little explanation of where this all came from. I started investing in mining stocks in the early 1990s, but I was doing gold mutual funds. And then in 2004, a friend of mine said he was going to invest in silver mining stocks. And I didn't even think of that. And he said that silver had a better upside than gold, so I did a little research. But there were no mutual funds for silver at that time. So the only way I can invest in silver mining companies is to learn how. So I started the learning process, and which wasn't easy, but I'm trying to help you with my website, with my book, and with this YouTube video to help you speed up that process. So that's where this came from. Now let's get going. So the difficulty in investing in a gold mining stock, when I say gold mining stock, I'm also referring to a silver mining stock. The difficulty is not knowing how, and it takes time to learn how to do it. So I would say that it takes at least 2 years before you get a good understanding of what you're doing. You can do what I did and start right off the bat and start doing it. But you're not going to get real comfortable until about 2 years. Till then, you'll be a bit in the dark. So there's an educational effort on your part. And the reason why is because there's just so many data points that you have to learn. But once you learn what to look for, all the different parts of the information you need to know, there are benefits. For instance, you will stop making mistakes. You'll start feeling more comfortable on what you're investing in. For instance, yesterday a member sent me an email to take a look at Red Eagle Mining. Took a look at it, and I couldn't punch any holes in the stock. I had to buy it. I put it on my buy list. Because I went down the checklist and looked at everything and couldn't find a problem. And when I find a stock like that, I buy it. And it increases your potential. You increase your risk reward because you're making good choices. You're looking at all the different angles, if you will. So the starting point is collecting data, and there's a lot of data points. So when you want to invest in a stock, first thing you're going to do is you're going to look at all the various pieces of information about that stock. So you're going to want to know, what's the current market cap, what's the share price, what's the stock chart look like, the fully diluted market cap, the resources, the ore grade, share structure, the management team, the location, growth potential, the cash debt, timelines, total growth, guidance, cash flow, future valuation, current valuation, the risk levels, guidance from management, recovery rates. So you have all these data points, and I'm going to be going over those a lot of those in separate slides. So I use a checklist. It's 10 points, and that's what that Mining 101 is on my website. It has the 10 points, and that's what we're going over today. And if you check all 10 points, use a systematic approach, then you should feel comfortable when you invest in a company. You should know what your risk level is, what your potential return is, have a good idea. So the end result of my analysis of a company is a rating, which I came up with. And my rating gives me an understanding of the potential upside of that company. So I'm looking for companies that have ratings of 3 or 3.5. And that's at least a 5-bagger. That's what I'm after. And I think, especially right now, we had this big correction over the last 2 years. It's easy to find companies that have potential 500% returns. And as you'll see today, some of these companies have potential 100% returns. I'm sorry, 1,000% returns. Oops, I had to say sorry 3 times. 10,000% returns is what I meant to say. And I'm going to show you one at the end. Okay, so step 1 is properties. And the first thing that I look for when I look at a property is, or a company's properties, is do they have a flagship property? And I've learned from experience that if I invest in companies that don't have flagship properties and they don't have a clear path to production, that I'm setting myself up for potential loss. But if you invest in companies that have solid flagship properties and those properties are economic, you're reducing your risk substantially. Especially if these companies have all of the other factors. They don't have a lot of red flags. And I'm going to show you all those other red flags, such as not being economic, not being in a good location. So I'm going to show you some of these other red flags. But if you find companies with flagship properties or potential flagship properties, which I consider 2 million ounces in gold and 40 million ounces of silver or higher, you find those with good economics and good valuations, that is the way to go. So that's what I'm looking for when I look for a property. Next thing I'm looking for is growth potential, size of the property, size of the mineralization. So I don't like small properties, say less than 300 acres. Even a 300, 400 acre property I'm not too excited about. I like 10,000 acre, 25,000 acre above properties. I like big properties. For me, that shows a lot of times exploration potential. Why would a company stake that large of a property if they didn't think the mineralization was on it? So I like that. So the size of mineralization, so if you have a property, let's say that it has a strike length of, say, more than 2 kilometers or more than a mile, that's a real good strike length. So you like that, the potential size of mineralization. Some of these have, 5, 10 mile mineralizations, and that's what you're looking for, because those are all potential drill targets. Another thing I look for in property is the percent explored. So if you have a company that has a discovery, but only 10% of it has been drilled, but they think that they have mineralization, they just haven't gotten to it yet, that's a good thing. You want to find projects like that. And then pipeline of projects. You like to see companies that have 2 or 3 properties in addition to their flagship property that they can go to next. It can be their next mine. You like to see a next mine in the pipeline. It doesn't have to be that. A lot of these companies might not have a pipeline, but they're going to have cash flow, and that cash flow can easily turn into a project. So a pipeline isn't a necessity, but it's kind of a nice thing to have. Checklist. A lot of these checklist items I'm going to list here are on separate slides, so I'm not going to go over them. Such as resources, the types of resources. I'm going to go over that on another slide. If it's inferred, measured, indicated, proven, probable, what those mean. The location has a separate slide. Cash cost per ounce. I think I do mention that on a separate slide, so I'm not going to do it. Grade and recovery rates are important for the valuation of the companies, and I will mention that hopefully on another slide. Exploration program, if they have an exploration program or not, it's important. For me, I want to see a company that's drilling every year. I don't want to see no drilling going on. I want to see at least 10,000 meters drilled every year. 10,000 to all the way up to 100,000 meters a year, because that drilling is going to turn into news releases. It's going to turn into information. It's going to push the stock higher. Potential size of the property, the potential size and the resources, the growth, the mine life. I like to see the mine life at least 10 years, ideally 15 years or longer, because when the mine life gets shorter, investors are going to run from that project. So you don't want to invest in properties that have short mine lives. What is the company's, what are the plans for the property? I like to see guidance. Guidance is very important for me. If I'm not seeing guidance, I'm not happy. I'm going to talk a little bit more about guidance down the road and some of these other slides. Ownership, I want to see, I like 100% ownership, of course, of the property, but in the mining business, a lot of these are co-owned, where they have joint ownership, where one company will own 30% and the other is 70%. I'm comfortable 80% or higher. Wildcat Silver, I have invested in that. They have 80% of the silver project. I'm fine with that. It's nice if they have more than 80%. 85, 90 is good. I'll go as low as 75%, but I'm not real comfortable with 75%. Anything below that I'm going to avoid unless it's a project generator. Project generators are kind of all over the map. They're going to own all these different percentages. 30 they might own 30% of one project, or 3% NSR of another one, which is a royalty. So on project generators, I'm not really concerned about ownership. Okay, the people management team. There's two types of management teams. You have your exploration project generator, which is, I'm guessing, maybe 90% of all your companies. There's about 1,500 mining companies out there, and by far, the vast majority of them, 90%, it's probably more than 90%, are exploration project generators. A lot of them are very tiny. Those companies have one objective, and that is to find a mine, find a potential mine. And then they will either, once they have a discovery, they might immediately go out and try to option that property to a developing company. And the developing company is going to complete the exploration and then build and develop and operate the mine. Now, the project generator has no intention of developing and operating mines. They will just go from one project to the next. So each time that they find a project, they'll try to option it or sell it and then move on. And the project generator model, a lot of people like it because it can keep your share dilution down, because they'll use other people's money to explore on their projects. But for me, I'm not too excited. I prefer to chase cash flow. And project generators, a lot of the project generators do not have very much cash flow. It takes a long time, because they have a small percentage of a project, for them to build up to have enough cash flow for that stock to really perform. So there are some project generators that do okay, but they're not as explosive as your developers. So I prefer to chase cash flow. I prefer to chase the developers. Okay, let's move on. Next thing you want to look for on the management team is you want to look for experience, the reputation, and if they have a reputation in the past, their track record. Have they built a mine before? What have they done before? And a lot of these companies, they might say they're say explorer/developer, but they've never built a mine before. It's their first mine. So how much experience do they really have? So you have to kind of do a little bit of research, read a little bit, find out where they came from, and get a better idea of the management team. Management teams are very important for investing in mining companies. A lot of people say that management is literally the key for making money and investing in a stock, and there's probably truth to that. And it's more important for your developers than your project generators, because the project generators, all they have to do is drill and find a mine, excuse me. But developers is a whole another animal. It is such a difficult industry, it's difficult business, because you have to plan the project, plan it out, plan how you're going to mine it, and then you have to execute, and you have to finance it, and you can't make mistakes. So it's difficult. So it's true. Management can really be crucial for making money, and a lot of people try to chase after experienced people that have done it before. So you'll see those stocks perform really well because people know they have good management team. Next thing you want to look for is, are they investor friendly? Investor friendly is something you will come to learn, come to understand. a lot of these small companies, they literally own a printing press. They can print stocks and do issue new shares and raise money and then pay themselves. And so you'll see this dilution. It's called, share dilution. And so they can issue stock. Some of these companies will issue stock twice a year, and they keep diluting the company. And the management ownership will be like 2%, 3%. They don't have a lot of skin in the game. They're just paying themselves. So you have to be very avoid those type of companies. You want companies that have a stake in the company. Say they own 10% or 15% of the company. Since they have a stake in it, they're not going to dilute the shares, and they're going to be more cash focused. And what I mean by cash focus is they have like a 2-to-1 ratio, two times as much cash as debt, or 3 times as much cash as debt. They'll have more cash than debt. Sometimes they'll have no debt, and that's a totally cash focused company. But companies that they have the other way around have twice as much debt as cash, I'm not so excited about those companies, because that tells me that the management is just trying to grow the company using debt. And companies continue to grow companies. They're not necessarily going to return that money to your shareholders. So you'll understand this difference between a company that's kind of investor focused versus and investor friendly versus management focused. Research the CEO. Try to see if you can get a video of them, or if you can't get a video, try to get an interview and get a feel for them. See how investor friendly they are and how focused they are. And they'll tell you if they're looking out for the shareholder. The size of the team. What I mean by the size of the team is if you want a company that's going to build a mine, if it's a small exploration company and it's a 4 million or 5 million ounce open pit project, they're not going to be able to do it. They just don't have the expertise. They don't have the manpower. It's not going to happen. So they're going to end up optioning or selling that project. So if it's a small team, you have to be a little leery if they say they're going to develop it. Share structure. So the share structure is you have your outstanding shares, which is your common stock. So if you go and do a quote on Google, it'll show you in there the number. Usually it'll show you the common stock. So the market cap is your common stock, your outstanding shares, times your market cap. But that's kind of misleading on the true value of the company. The true value of the company is kind of hidden, which is underlying part of that stock price is your fully diluted shares. And the fully diluted shares include options and warrants. So I always value a company on their fully diluted shares, the total there, times the market cap. And that's what I consider the current value of the company. If somebody's going to go to buy it, that's what they would buy it at. Now, the options are what they give employees, or they give management, or they give the board of directors. Now, the options are given away for free. So let's say a company's trading at $1. They have to give those options to, say, an employee above the current price. So if it's at $1, let's say they give them at $1.20. So they go and they give them 10,000 shares at $1.20. Well, those shares are not in the money, so they're not worth anything at this current time. So they'll hold on to them. Once those stocks become in the money, they can sell them and they convert into common stocks. So it's like free money for an employee based on the company grows. And the warrants are the same thing. They're basically options, but they're given to investors. And they're given to investors when they buy common stocks. So let's say that they need to raise money. So if they're going to raise, $5 million, the only way, the easy way to raise that money is in addition to, so they'll raise the 10 million or 5 million through a common shares offering. So that they sell the shares. So let's say it's $1 a share, 5 million shares. They issue 5 million shares common stock, and then they give them a half a warrant for every share that they bought, free. So they would give 2.5 million warrants out for free. And then those warrants are just like options. Once they hit a strike price, the investor will turn those warrants, or they'll sell those warrants for the value that they're at. And the warrants will actually sell, even if this is kind of a sweetener. The warrants, you can actually sell the warrants before they're in the money. So the warrants will actually have value, so they're actually giving them money. They literally give them money. So they buy the common shares. They can turn around, like they give them the common shares at a discount. They can turn around and sell the warrants for the discount of what they're currently selling for. So it's like buying common stock at a discount. I think sometimes there's a period they can't sell the warrants immediately. They'll have to wait. But the warrants do not have to go into hit the strike price, because the warrants will actually trade just like stock. Okay, and you can buy warrants. You instead of buying shares of a company, you can actually buy warrants. It's like you can do some research on it, but you can buy options of a company, but you can also buy warrants. Tight share structures are ideal. The reason they're ideal is because investors know that a tighter share structure has more value. And so it has more value because each share is valued on ounces, also has a valuation on how many ounces are in the ground. So how many ounces is that share worth? So if it's tightly held, let's say that there's only 50 million shares outstanding and there's 50 million ounces, it's 1 ounce per share. 1-to-1 ratio, whereas if it's highly diluted, then that doesn't have as much value. And investors know this, so a highly diluted stock they're going to avoid. Now, a share structure is somewhat meaningless for a company without cash flow. If you don't have cash flow, then you could dilute. You could dilute those shares. But if you have cash flow, and it's tightly held, the unit is going to stay tightly held, because management knows that investors want to have it tightly shared. Another reason why investors like tightly held is because each share has more value when it comes to dividends. So let's say we have 100 million fully diluted, and they issue a $100 million dividend. That's $1 per share. So it's more money per share for your dividends when it's tightly held as well. And people know this, so they try to avoid. So highly diluted should be avoided, but not completely. I have several shares that are companies that have more than 400 million, but I only do that because they're really super cheap. And some investors, they will buy. They don't. It doesn't really bother them. They have 500 million fully diluted shares, but I personally prefer to buy under 100 million, and I like to average 150 million. So I personally recommend that highly diluted should be avoided. Some people will argue that it's not that significant. But there's this psychological factor that I really like. And the psychological factor is that, let's say that you have really tightly held shares. If you have really tightly held shares, let's say you have 100 million shares outstanding, that's not really tightly held. I mean, 50 would be really tightly held. If you have the share price goes up 10%, it's going to be very noticeable. Whereas if you have a really highly diluted shares and it goes up 10%, it's not noticeable. So you have this psychological effect. And this is one of the reasons why you'll have this explosive stock price. The explosive stock price is because the stock price seems to really be moving fast, and people notice it. It goes up 50 cents. It can go up 50 cents in one day. People will notice that, even though on a percentage basis it would have been the same. It would have been the same move, but since it's tightly shared, you have this explosive stock price. I mean, it can go from $1 to $10 really quickly, even though the percentage move could be the same on a highly diluted shares. And I mentioned each share has more value than dividends. The location. The location is probably the first thing that I look at when I invest in when I look at a company. Because if it's not in a good location right off the bat, I'm not going to be as excited about it. Because I don't want to invest in an unfriendly location. And for instance, I'm not going to invest in Venezuela, Bolivia, or Ecuador. Those I consider unfriendly. And places right now that investors are somewhat avoiding, for instance, are Africa, especially South Africa. Other places they're starting to avoid are Argentina is starting to get some flack because Argentinian government and even Peru and Chile are starting to get a little bit of resistance. So I might look, but I want to know. I want to know where that company is, where they're based, if they have, they could be globally based. They could have, properties all over the world. Most of them have, one or two main properties in the Pacific location. Now, ideally, you want to invest in a mining friendly. For instance, Canada, Mexico, Australia, Brazil, Colombia, and Guyana. Guyana is in northern South America. USA, Idaho, and Nevada I also consider mining friendly, although they're not as easy to permit, for example, as, say, Mexico. Canada is starting to get more difficult to permit in some places, although Ontario and Quebec and Yukon are pretty easy to permit. And Mexico is actually pretty easy to permit. So I like to invest. Ideally, you might want to invest in Canada. There's probably 30 excellent mining stocks in Canada right now. You can just focus all in Canada. But finding a mining friendly location is important. The location of stocks is very important. The first thing, the most important thing for infrastructure is it near an existing mine? If the mine is near an existing mine, and that mine existing mine is currently operating, and they don't have any issues around it, say they don't have any native issues or any type of litigation or anything like that, nationalization issues, then that is an ideal place as far as infrastructure. So we want to find mines that are near existing mines. If they're not near existing mines, it can really increase the capex. For instance, if you have a mine that's in Alaska, that's in the middle of nowhere, that's 50 miles from the nearest road, you're not going to have access to water. You're not going to have access to electricity. You're not going to have natural gas. So you have these increased capex requirements. So if it's a small exploration company, there's no way they're going to be able to afford it. So always look for, if it's near existing mines is a big positive. And then political risk is really been on the increase recently. Especially we're starting to see ecological resistance in places like Indonesia and the Philippines, and even places in Africa and in South America. We're starting to see more ecological resistance and a lot of native issues. We're starting to see native issues in Canada even. Nationalization efforts. So we're already seeing nationalizations in Venezuela and Bolivia. And in Ecuador we're starting to see issues. And so that's kind of on the rise. You have to be careful. Royalties and taxes have not been an issue recently, but I think in the future we could see increases, especially if the price of gold goes up. Permitting, you always want to know, are there permitting issues? How long is it going to take to permit certain areas? For instance, Washington and Oregon, I've seen a few mines, and it takes a long time to permit. California can take a long time to permit. Montana as well. So you got to look at permitting issues, worker relations. Africa seems to have a lot of strikes, litigation, ecological issues. Okay, so that's the location, and that's part one. We're going to do 3 parts for these YouTube videos.